Okay, good morning. This is Professor Mayer, and what we're going to be covering in Chapter 5 relates to a couple of very important preliminary steps within the audit process. We're going to spend a little bit of time talking about risk, and then we're going to be talking about the concept of assertion. And the assertions become very important because these are the elements within the financial statement that we are actually testing. The first very basic concept related to auditing is risk. Risk does not mean that something bad has happened. Risk means that something bad could happen. So let's talk about risk in general, and then we're going to focus on this concept of audit risk. Well, risk in general essentially is something bad that could happen. And we tend to relate risk to internal controls. So the very basic concept is that the reason we put a lock on our front door is because there is a risk that someone might break into our house or our apartment. The locked door does not eliminate the risk, but it certainly does reduce the risk that something bad could happen. So you notice the connection between risk and internal controls. Now let's relate this to this concept of audit risk. Now keep in mind that we'll talk about risk from a number of different perspectives in this chapter, but let's first focus on audit risk. Audit risk means the risk that the auditor issues an inappropriate financial statement audit. Primarily what we're looking at is this is the risk that the auditor is issuing an unqualified or a clean opinion when in fact there are material misstatements within the financial statement. The next basic concept related to auditing is this concept of financial statement assertions. Keep in mind that management is responsible for the financial statements. Therefore, as they prepare and present the financial statements, they are making specific assertions. So you notice we talk about assertions related to account balances, assertions related to transactions and specific events, as well as assertions related to disclosures. Think about this from this perspective. If management is saying that sales is, for example, $1 million, management is asserting that the account balance for sales is $1 million. They're also asserting that these transactions also took place. So the assertions become the basis for our auditing, because as you go through this process, what you'll notice is that what we are actually testing relates specifically to the management assertions related to the financial statement. Let's go a little deeper into these financial assertions and give some examples, and in a few minutes we'll give a specific example of how these assertions relate to each other. So as an example, in account balances, we're looking at existence. So if we are examining assets, what we want to know as the auditor, do these assets actually exist? Rights and obligation. Do we have rights to the items that we count? For example, there may be inventory, but the question becomes is, do we own that inventory? For example, the inventory may be there on consignment. And if that's the case, that's not our inventory. Is it complete? Are there assets or liabilities that exist but are not showing up on the financial statement? Valuation. As an example of this is accounts receivable. We don't report gross accounts receivable. We report net accounts receivable minus the allowance for doubtful accounts. So as the auditor, we are valuing accounts receivable to ascertain that the accounts receivable reported represent potential cash that will come into the organization. Similar assertions relate to transaction. For example, did the sales transaction occur? When we're looking at transactions, whether sales or other types of transactions, is the list complete? Is it possible that there were transactions that occurred and yet they were not reported in the financial statement? Let's finally talk about assertions related to disclosures. Disclosures are part of the financial statement, and disclosures are the responsibility of management. As we are reviewing and auditing these disclosures, we want to make sure that they represent events that actually occurred, that any recognition of assets or obligations within the disclosures are related to rights and obligations of the organization. We want to make sure that all disclosures are there. In other words, they're complete, they're accurate, and evaluations are done appropriately, as well as classification and understandability is the final element of our disclosures as we audit these. Later on in the chapter, as well as the course, we'll provide additional guidance related to the actual testing that we're doing. But I thought this would be a good time to give you an example of how we actually test the financial statement assertion. So you notice this table here where we're looking at occurrence and completeness. Now keep in mind that if we were testing the financial statement assertion for assets, instead of saying occurrence, we would test existence. Same basic concept. But in this case, when we're testing occurrence or existence, we take a look at the journal or the ledger to identify what transactions or what assets are actually listed. Then, as an auditor, we go out and search documents that support the existence of the occurrence or the existence of the asset. If we're testing assets, many times what we're doing is we're actually looking for the physical asset. The opposite end of the spectrum related to this testing relates to completeness. What we are interested in is making sure that the transactions and the assets are completely reported within the ledger. So we will randomly take a look at transactions and trace these back to the journal to make sure that these are reported. When it comes to assets, we will randomly pick assets and trace these back to the journal to make sure that the assets are listed within the financial statement. Let's go back to a concept that we discussed earlier and go into a little bit more detail. What we're looking at here is audit risk. Now remember, audit risk is related to the risk to the auditor. The auditor does not want to issue an unqualified opinion when in fact there are material misstatements in the financial statement. However, we will never get audit risk to zero. Well, why is this? We must complete the audit within a reasonable period of time and within budget. Never forget the fact that a financial statement audit is a for-profit enterprise. This may be different than maybe considering a government audit. But in addition, we are consuming tremendous resources of the client. The client wants the audit done as soon as possible. They need this audit to issue their financial statements. And in addition, the resources that we consume within the finance department, as well as other areas of the organization, are such that the client really does need this audit done in a very efficient manner. And they are willing to accept reasonable assurance as opposed to absolute assurance in the audit. Let's now take a look at the audit risk model. You notice there are three elements that equal our audit risk. Now think about these elements as the product of variables, and the goal is to reduce audit risk. Therefore, if one of the variables is high, we want to mitigate this high level with a decrease in another one of the elements. And this will become clear as we discuss these elements. But let's first talk about each of these elements. Inherent risk is what is inherently risky about the transaction, the asset class, or something else within the financial statements. So as an example, cash is inherently risky. If we're conducting an audit of a diamond retailer, the inventory is inherently risky, not only from the potential theft, but also from a valuation issue. Control risk is mitigated by internal controls established by the organization. As the controls are more significant related to the inherent risk, then the control risk goes down. So you notice that the inherent risk and the control risk are what we as auditors consider the risk of material misstatement. In other words, what can go wrong due to its inherent risk and what is management doing to mitigate this risk. Let's now talk about what the auditor is responsible for. During the course of the risk assessment, the auditor is going to assess the risk of material misstatement. Based upon this risk of material misstatement, the auditor will plan the nature, timing, and extent of audit testing. So as an example, if the risk of material misstatement is high, because possibly the controls are not in place to mitigate the inherent risk, the auditor will perhaps increase the amount of testing in our substantive testing. We will talk about different types of testing in the next video, but at this point, what we need to make sure that we understand is that the auditor wants to manage audit risk. The auditor, during the course of the audit, is testing the management assertions, and the actual procedures that we're going to do are going to be discussed in the next lecture.